Now you should have an understanding of how buying and selling put options can lead to gains or losses depending on where the stock price ends up relative to the selected strike price at expiry. Now, we're going to move on to the other contract, which is a call. You're going to see that it's very similar to puts, but with some slight differences. We will now be examining how to know when to take a call contract. To better understand that, we will be looking at the terms of agreement when entering a call. Again, this is critical knowledge in understanding how to make a favorable transaction when selecting a contract. We'll first look at how stock price action relative to our chosen strike price will affect the outcomes for both buyer and seller. Let's take a look. With every contract filled, there is a buyer and a seller, and every contract commences with the contract buyer paying a premium to the contract seller. Let's look at what they are agreeing to when they enter a call. The contract buyer agrees that if stock price ends up above their strike price during the contract period, they have the right, but not the obligation, to buy 100 shares contained within that contract from the contract seller at the strike price value. This is below the current value. They will profit by buying shares for less than what they are worth. This is referred to as assignment. Let's take a closer look. If 100 shares are bought at the strike price for $60 times 100, so $6,000 in total, and then sold at the current price of $70 times 100, so $7,000 in total, then that's a $1,000 profit minus the initial premium paid, which will be small compared to the profit made. So let's take a look at that same example, but from the perspective of the contract seller. The contract seller agrees that if stock price ends up above the strike price during the contract period, and if the buyer initiates assignment, they are obligated to sell 100 shares contained within that contract to the contract buyer at the strike price value. This is below the current value. They will lose by selling shares for less than what they are worth. This is referred to as assignment. Let's take a closer look. If 100 shares are obtained at the current price of $70 times 100, so $7,000 in total, and then sold at the strike price of $60 times 100, so $6,000 in total, then that's a $1,000 loss. They can still keep the initial premium, but that will be small compared to the loss made. That first example I just provided was assuming that at expiry the stock price ends up above our strike price. So let's take a look at the second alternative where at expiry stock price ends up below our strike price. If stock price stays below the strike price during the contract period, then it is extremely unlikely the contract buyer will initiate assignment to buy 100 shares. There would be no point. No assignment occurs. Let's take a closer look. If 100 shares are bought at the strike price of $60 times 100, so $6,000 in total, and then sold at the current price of $50 times 100, so $5,000 in total, then that's a $1,000 loss. It wouldn't make sense to do that. But remember, they paid the initial premium to the contract seller. That is not returned to them, so that is a small loss. So let's take a look at that same example, but from the perspective of the contract seller. If stock price stays below the strike price during the contract period, then it is extremely unlikely that the contract seller will be subjected to assignment of those 100 shares. As explained before, there would just be no point. No assignment occurs. But remember, they receive the initial premium from the contract buyer, so this will be a small gain. So hopefully now you've understood how a call can lead to an advantageous transaction for both the buyer and seller, depending on where price action ends up at expiry relative to the strike price level. So let's take a look at the key takeaways. To commence a contract, the contract buyer will pay a premium to the contract seller. For a call contract, If price ends up above the strike price during the contract period, the buyer has the right, but not the obligation, to buy 100 shares contained within the option contract for a profit. The contract seller is obligated to sell those 100 shares for a loss. Assignment occurs. This benefits the contract buyer. If price stays below the strike price during the contract period, the contract buyer will not exercise the sale of those 100 shares as it would equate to a loss, but the contract seller keeps the initial premium paid. This benefits the contract seller. I understand now that we're starting to get a little bit more intricate with our lessons. Feel free to rewatch the videos until you understand the concepts in the last videos. It's critical. You can't blindly trade in options or you'll end up getting shadow rolled. I can't stress how important it is to understand the basic mechanics of it all before even thinking of trading. And that's really all we are looking at the moment are the basic concepts and rules. As a buyer or seller entering into an option contract, now you'll understand what you are obligated to do and not obligated to do upon contract expiry. See you in the next lesson. Have a good day.